Welcome to this episode of Skipton Talks. And today with me on the sofa, we have Paul Shearman, Proposition Director, Mortgages and Protection of the Openwork Partnership. So welcome, Paul.
Thank you, Paul, for having me. Honoured to be on the sofa today.
And thanks for coming all the way from Swindon as well.
A bit of a trek.
Yeah, that's a long way. I think you might just hold the record. I'll have to check. But thanks very much. And before we get into business and what's going on, just tell us a little bit about yourself.
Well, do you want my full CV?
No.
Okay,
Let's just do the last few years for the benefit of the viewers.
So background, I spent a bit of time in consultancy, a bit of time working for Abbey National, if you remember them, a bit of time in insurance with Eagle Star, and then joined the Zurich Group, which we ended up morphing into the Openwork Partnership,
right?
And that was 2005, so it's our 20th anniversary this year. So I have responsibility for the proposition that we take to our advisors across mortgages, protection and general insurance. And I guess my ultimate objective and obsession is to try and make sure that the proposition that we have for our advisors and in turn their clients is as good as and ideally better than anybody else that's out there.
So what is the Openwork Partnership's mission? What are you trying to achieve?
I think because we don't have a brand that is promoted through to end customers, we probably don't have the level of visibility and awareness that some of our peers do have. But we're quite a big business now. So we are 700 odd staff. We're turning over £500 million a year. And we've got over 4,000, approaching 5,000 advisors now. And from a scale perspective, in terms of providing solutions to clients, we will do about 120,000 mortgages for clients every year. 140 odd thousand protection cases, 80 odd thousand GI cases, and then we got 800 or so wealth advisors. So we're also supporting our clients in terms of their savings, their investments, their retirement planning, and I've got about 12 billion in terms of funds under management within our own funds. So we're quite a big business in that regards.
So those 120 mortgage advisors, are they 120,000? Are they across all sectors?
We're a very broad church. So we've got players who play at top end of sort of Bishop's Avenue and £20 million plus properties in London, all the way through to shared ownership. And from a share perspective, in terms of the UK, our biggest market shares is probably Northern Ireland and Scotland. So a very broad base of advisors and client profiles as a result of that.
So you can have a view on all of the sectors because you cover them quite widely. Okay, perfect. So my words, we've had a cautious but largely positive start to the year. How do you see the rest of 2025 playing out?
I think we're probably in a similar space to you in terms of how it started. We're probably up about 2 or 3% on last year, so it's reasonable. But I was probably expecting 5, 6, 7%, and I think there's probably a number of reasons for that. I think the bank base rate drops haven't probably come through as fast as people were expecting. The autumn budget created quite a lot of concerns and worry, I think, for people. And then the shenanigans across the pond has probably not helped in terms of sentiment. So that's sort of held things back a bit. In terms of the rest of the year, I'm a bit more bullish, being honest. So we've got probably 2 or 3 more bank base rate drops, which will help sentiment. There's also a massive amount of maturities coming through in the second half. I mean, there's a big blip in June, and then I think from memory another one in September, October. So there's a lot to go after in terms of maturities, and the latest figures I've seen in terms of the quarter 1 2025 versus quarter 1 24. Remo's coming back quite strongly in terms of that mix between Remo and PT. So lots of maturities and a better mix, which from a customer outcome perspective, but also just from a commerciality perspective in terms of brokers, I think will really help. I mean, we've all heard the testament from advisors of having reworked cases multiple times over the last 18 months and then ending up on a PT and earning pennies. That's not commercially viable. So if we see Remo coming through more strongly in the second half, I think that should help. So broadly, a stronger second half of the year probably. So overall a solid year, but in terms of some of the original numbers coming out of the likes of UK Finance and IMLA, I'm not convinced we're gonna deliver that. I'm not sure. So I think last year ended up at about 242 billion in terms of lending. This year probably 255, 260 maybe. So solid. And then if you then factor in the product transfer opportunity as well, you've still got over a 500 billion pound market opportunity for people to go after.
And there's plenty of opportunity. And I guess your view would be lenders will really play out their competitive, the competitive landscape for lenders will play out in the remortgage.
I think so, yeah. And I have to say, from an appetite perspective, almost every single review meeting I'm having with lenders, they're talking about increasing share, increasing the amount of lending, which bodes well for brokers and competition and pricing and for consumers as well.
Absolutely, and I think I agree that all the narrative kind of Q4 last year was talking up 2025, and I had a conversation with an owner of a reasonable sized network not long ago, and I said, "How's Q1 gone for you?" And he said, "All right, we expect it to be better. We've got a lot of maturities coming up. That's where we'll really start to see the value." But it was kind of, it's okay, but we thought it might be a bit better than it was. So fingers crossed, the market picks up and delivers what we all expect it to deliver. So moving on to your sponsorship of the Rated for Service Lender Survey, which was released recently. So in a world where price rules, let's say, how important is service? And for those of you who don't know what I've got a copy of the report here signed by Paul, so I'll have that on eBay straight after this interview. So joking aside, so we all try to price appropriately, and in a world where brokers will say price is really important, where does service really factor?
Okay, so just taking a quick step back for people that aren't familiar with it. So the survey, we've sponsored the survey with combination of Mortgage Finance Gazette and Mortgage Strategy for the last 3 years. And it sort of came out of a meeting that we had with them to talk about how we could work together. And I'd had a number of meetings with lenders, and a lot of lenders do their own sort of NPS, Net Promoter Score, their own surveys. And I was getting lots of feedback from lenders saying, well, actually, our NPS scores are really good. And I'm thinking, but actually the feedback I'm getting from advisors doesn't necessarily align with that. And the key bit that Rated for Service delivers is a decent sample size. So we've got over sort of 600 odd advisors that have taken the time to complete it. Therefore, objective data, but also benchmark data. So you can not only see your scores, but you can see relativity versus your peers. So that's what's really valuable to it. And there's, I think they quoted 150 hours in terms of survey completion times that advisors have put into it. So there's lots of verbatim comments. So there's lots of really good feedback that we can take out to lenders to hopefully not only celebrate the lenders that are doing a brilliant job, but also to a degree hold feet to the fire where things need to be improved. But jumping back to your original question about price versus service, clearly we encourage, and the FCA encourages advisors to look at top of the table in terms of pricing. But at the end of the day, the advisor is recommending the lender to their client. And therefore, if they don't trust that the service delivery is going to be strong and therefore not denigrate their own relationship, their own brand, they're not going to do it. So within the data, you will see some players that come out really well on pricing and product, but every other factor they're really poor on. Actually, if you're making the journey for advisors as well as clients really, really painful, that inevitably is going to hit everybody's reputation, but more broadly your commercial success.
And it becomes difficult to recommend if you're not sure. It's going to take weeks to get the offer or hours to answer the phone. Let's come on to first-time buyers. At Skipton, we have a really clear purpose in terms of first-time buyer is what we want to talk about, is who we want to represent, is the sector we really want to encourage growth into. And we continue to discuss that with everybody we talk to, and it's an important narrative for us to maintain. Where will lenders win or lose this year in the first-time buyer sector?
That's a tough one.
It's not easy.
So I guess overall, in terms of our business, first-time buyers have been quite strong at the start of this year. So I think they probably represent about 30-odd% of our purchase business in the first quarter, which I don't think is out of line with the broader market. I think we deliver significantly higher than that for you guys because of your focus on the sector. But it feels as if there is still there's still clearly demand, and there's still a decent volume of first-time buyer business coming through. Winners and losers. I guess the two big challenges for first-time buyers are deposit and affordability. So lenders that can respond in those two areas are probably going to be the ones that are likely to be most successful. Clearly, you've got the regulator and Treasury and talking about potentially some flexibility around affordability, around stress testing, around LTI levels, and if that comes through over the next few months, I think there's consultation up until June, something like that. The lenders that respond quickly to that might success, have most success. The innovation's clearly key, and you guys have led the way in terms of track record, for example. But there's a lot of, it feels like there's quite a lot of activity in the first-time buyer space. Many of in terms of review meetings with lenders, almost every single one, they're talking about the first-time buyer opportunity, and there is more innovation coming through. We've added. Am I allowed to mention another lender? Gen H we've added, for example, who have made a real difference, and they're not doing massive volumes, but they've got some good ideas. They've got some good tech. There's innovation around shared ownership. There's quite a lot of schemes going on around the shared equity space. So there's innovation coming through, and that that will help, and clearly that enables advisors to talk about the opportunities in first-time buyers. And I think that's probably in terms of where who's going to be successful. There's still a significant proportion of first-time buyers or renters who don't believe that they would get a mortgage. At which point, working together with advisors to educate, inform. You've got the Skipton Affordability Index, for example. It's great. You've got a first-time buyer help desk for brokers. Anything you can do and lenders can do to support advisors having that conversation and educating and informing potential first-time buyers will really help. And those that you guys are clearly leading the way in terms of your messaging, and you've got social purpose around it. The more of that we see across the industry, I think will help.
Okay, so we've got some potential changes to lending rules where we could all be a bit more flexible, but innovation is still key from a lender perspective.
Yeah.
Okay.
It's interesting if you look at the. I think the latest stats in terms of intermediary versus direct business, about 87% of the market last year was intermediated.
Oh.
If you look at first-time buyers, it was 91%.
Okay.
So, interestingly, even though they're probably a bit younger and you might expect them to be more technologically savvy, possibly, clearly first-time buyers really value the support and advice they can get from brokers. Yeah. So, lenders working together with advisors can be helpful.
I agree. Their lives are more complex. The way they earn is more complex.
Yeah.
How they're employed is more complex. So the value of advice in that world is completely crucial. Last question. Thanks. And it's a wish from you. What is the one thing you would ask from Westminster this year to support our industry?
I think I'm going to struggle with one.
You can. You've got the mic. You can have,
okay.
You can have a few.
Let's see how we go on. So I think if you go back to prior to the election, I think within the Labour manifesto, there were 20 separate pledges around the housing market and dealing with the housing crisis within the manifesto. And clearly the government's come in and then they sort of start getting into the detail and everything is more difficult, more complicated than you think it's going to be. The other one I'd raise, if I'm allowed another one, Paul, would be the whole sort of issue of ISAs.
Okay.
So I know the government's looking, and I think it's in the select committee, around LISAs.
Okay.
And whether or not the current model in terms of LISAs is effective, because you've clearly got a cap in terms of the amount which was put into place years ago. Yeah. You've got penalties if you take the money out to do something different other than property purchase or retirement. So I'm not sure that's working. So something around that. But there's also the issue of cash ISAs, and there's quite a lot of commentary around potentially reducing the cash ISA piece. Whether that impacts on building societies in particular in terms of funding, I'm not sure.
Well, I guess so. First of all, anything that makes it harder to save efficiently, to save for a deposit to buy a property, that can't be a good thing. Anything that makes it easier to save efficiently, to save for a deposit to buy a property, that's got to be a good thing. So, we would say, let's make it easier for the consumer to save, not more difficult. In terms of lifetime ISA, you're absolutely right. If there's a cap on how much the customer can, the property the customer can buy, and that cap was put on 8 or 9 years ago, well, house price inflation has increased significantly, so that absolutely needs to be reviewed. I guess us and our peer group will be lobbying hard to make sure it's as easy as possible for a customer to save money to buy a house, because it's in everybody's interest for that to happen.
Agreed.
Yeah, perfect.
Last one. Am I allowed another one?
You can go on as long as you like. Go on.
I didn't mean
go on. I meant we can talk as long as you like.
So the last one would be stop using landlords as target practice. I think we need a positive private rental sector, because I've got two daughters that have gone through the renting process in the last 12 months. It's really, really painful, and you have got clear evidence of landlords deciding to sell up. If there aren't alternatives in place, then that's just going to make rental really, really hard. So a bit more support for landlords, I think, wouldn't go amiss.
Well, hopefully we'll get that. I think I said in another recent conversation, we want our industry to be taken seriously. So let's hope that we get some continuity over the term of this government and beyond, so that we can all work together to enable consumers to buy and own their own homes. On that note, you can't have any more. We'll finish it there. Paul, thanks very much indeed.
Thank you for having me.
For coming to join me on the settee today. And thank you very much for watching this episode of Skipton Talks.